In this discussion, we will address the topic of cash management, the opportunities and challenges with cash inflows and outflows. By the end of this lesson, you should be able to identify opportunities and challenges related to client cash inflows and outflows, discuss cash flow management recommendations such as cash flow optimization, generating systematic savings, and building emergency fund assets, and offer recommendations to assist the client in reaching their planning goals. Cash management is a process. It starts with the planner understanding the client's prioritized goals and needs, the sources and reliability of current cash inflows, and the current disposition of cash outflows, including fixed expenses, variable fixed expenses, discretionary spending, and taxes. Sources of client inflows include earned income, interest and dividends, capital gains, alimony payments, employer pensions, Social Security and annuities, business income, rental income, and even reverse mortgages. You need to understand how your client is currently spending their income. As described in the pre-recorded lecture entitled Personal Financial Statements, there are 4 broad categories or groupings of expenses: fixed expenses, variable fixed expenses, discretionary spending, and income taxes. Examples of fixed expenses include mortgage and rental payments, auto and school loan payments, property taxes, insurance premiums. Examples of variable fixed expenses are utility and food bills. Discretionary spending include entertainment, vacations, home renovations, and contributions, but note that some clients may consider some or all of their contribution as a fixed expense. Personal tax liabilities include FICA payroll taxes, which is money collected by the government to support Social Security and Medicare payments, federal income taxes, and state income taxes. The financial planner can certainly offer value to many clients in regards to developing a workable cash management plan. In working with the client to develop a cash management plan, i.e. a family budget, the planner may need to help the client clarify his or her prioritized goals, balance current consumption wants against future benefit needs, and manage unrealistic expectations. In working with the client, you might want to refer to budgeting as cash management. Budgeting is sometimes interpreted as having to give something up or going without. Cash management has a better chance of being interpreted as being proactive and working to create a prosperous future. The planner's knowledge and guidance will help the client discover how to control cash flows and build a systematic savings portfolio. However, budgeting is not without its challenges. Challenges include generating consistent, positive cash flows and committing those to systematic saving program, maintaining a budget-minded discipline, building sufficient emergency funds, and controlling the use of debt. The big picture strategies for improving cash flows come down to simply this. The client can improve cash flows by either increasing cash inflows, decreasing cash outflows, or a combination of the two. The goal of these actions is to create a systematic net surplus. In helping the client identify opportunities for increasing cash inflows and decreasing cash outflows, you'll want to go through every line of that statement of cash flows. Is there a way to increase this income line item? Is there a way to decrease that expense line item? You'll use your knowledge of investments, tax planning, insurance, retirement planning, estate planning to answer your questions and to help your client. Income can be increased in a couple ways. Yes, your client could go out and get a second job or demand a pay raise. Perhaps the client has a hobby or a passion that might be developed into a second part-time endeavor. If that's the case, then it would not only help with cash inflow, but also have some excellent tax planning opportunities. But where the financial planner can help is with the reallocation of underperforming investments. What type of return on investment is the client earning? Is the portfolio set up correctly for the client's needs, objectives, and risk tolerances? Could the investment mix be changed to produce greater income? You examine the alternatives available in investment holdings in greater detail when you take your investment and portfolio management class. While it's difficult to reduce spending significantly with fixed and variable fixed expenses, it is very easy and productive to improve the cash flow situation by lowering discretionary spending. For example, a vacation could either be deferred or the itinerary changed to be less expensive. High-ticket purchases or entertainment expenses could be planned for or eliminated. The number of restaurant meals per week could be reduced from multiple times a week, perhaps one or maybe two. Note that it's important to involve the client in these decisions about how much and where to adjust discretionary spending. That's because the client is always the one in charge of their own plan. Restructuring debt is an effective way to replace high-cost credit card debt with lower-cost debt. In some situations, you might be able to roll up high-cost debt into a home equity mortgage refinancing or a home equity line of credit, which would help to lower the interest rate and qualify for deductibility of interest. Home refinancing at lower interest rates could offer tremendous relief to the cash-constrained budget. You'll explore debt management in another pre-recorded lecture this week. Later in the course, you'll explore tax planning strategies in detail. Strategies can help you to improve net cash flows. However, the content of this slide offers a preview of valuable tax planning strategy. How can you legally reduce the reported gross income? What above-the-line deductions could be used to reduce the adjusted gross income? For example, pre-tax contributions to qualified retirement plans, IRA contributions, student loan debt. What below-the-line deductions are available, such as mortgage interest? What tax credits are available? Implementing recommendations that will effectively address these questions can meaningfully help to reduce the income tax liability. A planner should alert the client that there are many non-financial resources that could be used to help reach goals. A client's non-financial resources may include contacts such as families, friends, and associates, education and access to employer-reimbursed education, technical skills, interpersonal people skills, communication skills, experiences, attitude and health, and community resources such as scholarships. An emergency fund is designed to keep food on the table, electricity and heat in the house, and money for transportation and other basic living expenses during times when the normal source of income is disrupted. The money crunch might occur should a client decide to change jobs, become sick, or disabled. The client's assets are there just in case something challenging happens, and by definition, you never know when an emergency is going to happen. Therefore, assets held in an emergency fund need to be liquid. In other words, the value of the asset should not be reliant on whether or not the market is up or down that day. Typical investments for emergency fund assets include checking accounts, savings accounts, money market accounts, short-term certificates of deposit, and U.S. Treasury bills. Note that you could access the cash surrender value of your life insurance policy, take out a loan on a qualified retirement plan, or tap a home equity loan. However, these would typically be more of a last result after the liquid reserves are used up. The general benchmark for emergency reserves is 3 to 6 months of living expenses. So that's the non-discretionary expenses. Where the client falls along that 3 to 6 month spectrum depends on a variety of factors, including the number of wage earners in the family, the size of the family, and the projected time needed to get a new job. So how might we help the client improve their cash flow liquidity situation? As just mentioned, the first priority is to accumulate an emergency reserve equal to 3 to 6 months of non-discretionary expenses. That reserve might include the cash value of life insurance or the possibility of loans from qualified plans, as previously discussed. Other ways to improve liquidity is to contribute to a Roth IRA, because any early withdrawal is considered to be a return of principal first, so there wouldn't be a tax consequence. You might have the client secure a line of credit that could be tapped as needed. Also, improving a credit score could improve access to loans, and those loans would demand a lower interest rate than a person with poor credit. An important goal for nearly every client is to commit to a systematic savings program. As the saying goes, pay yourself first. The first dollar should go into savings, whether it's done by writing a check, making a deposit, or signing up for payroll deduction. The rule of thumb for savings is typically 5 to 10% of income. However, that would vary depending on the client's retirement goals, the timeline until retirement, and the employer retirement plan. It's important to prioritize savings. Don't leave it as an afterthought. I only considered once all the other bills are paid. One way to make it of a priority is to start today, even if the contribution amount is low. The value of starting today is that it creates a discipline, a habit, which only strengthens as the retirement account continues to grow in size. In this lesson, you learned about cash flow opportunities and challenges and recommendations to improve the client's cash flow situation.